Knowing the market always leads to better decisions. Stay tuned. Good morning, everyone, and welcome to episode 211 of Note School TV. So today, it is the market update, and Eddie and I are excited to bring that to you. Let's take care of a little housekeeping, and we're going to dive right into it. Number one, make sure and like this episode. Yep, go ahead and hit the like button, and please share it with your friends. This is the bottom line on the market. And it's a lot of information today, right? A lot of up-to-date information. So please make sure and share that. Number two, subscribe to the Note School TV channel if you have not already done so. And number three, hit that bell notification. Yep, boom, hit the bell notification so that you'll be, notified every Wednesday at 11:05 Central Time when we go live. If you'd like to hear more about what we do at Note School, simply go to noteschool.com/TV. Again, noteschool.com/TV. And with that, I am going to bring on, one of the busiest guys in the world these days, founder of Note School, chief visionary officer, all around good guy, Mr. Eddie Speed.
Good morning.
Yep, you're running around, Eddie.
The market is lively.
Yeah.
And that's a good thing.
That is a good thing.
That's a good thing. We got a lot of things going on the trading side, and we have a lot of people transitioning into notes that have been in other asset classes. And today we're going to really talk about why that's true, Joe.
That's exactly right. So, Eddie, I think we just jump right into this month's monthly update.
Let's do it.
Let's do it. So, Eddie, there's our new opening slide for this episode. So we'll see if we like this one or want a little better, but let's run to it.
All right, let's look at them.
Eddie, it's better to do the right thing at the perfect time than to do the perfect thing at the wrong time. A really smart guy that I know said that.
I was on a podcast one day and a guy heard me say that. And I say something similar to that fairly often. And he made a little thing of it, and our marketing team picked that up. But you and I've talked about that a lot.
We have.
You can't fight timing, Joe. You cannot fight market timing. You have to understand it, and you have to adjust to it. The times in my career that I thought I'm going to keep doing what I'm doing, I don't care what the market tells me to do, I can tell you right now that is foolish thinking.
It is. And Eddie, you've got to, as you and I were talking earlier, you've got to know and verify who you're talking to as well, as far as what information you're receiving.
Where are you getting your information?
That's it.
Right? Yeah.
That's it.
We'll talk about that.
Yep, for sure. Okay. So, Eddie, we've got, we know there's the different market cycles, and this one right here is certainly a note cycle.
Yeah, we started this probably, Joe, somewhere in 23, that It became very clear that we had entered into a note cycle, meaning that notes have more cash flow, less risk, more profit than other real estate things. And somebody that's dyed in the wool rent property person, they say that's not true. But the problem is their math isn't following what they're saying.
Yeah.
And so we've entered a note cycle, and that's why we're busy. But we want to kind of go through that. And we're not trying to shame people into looking our business. We're trying to maybe get them to look with logic and not do it in just, like you fool,
100%.
like not that. But in a spirit of a go-giver, we want to help them see things that maybe they're just not seeing, and show them some things they may not considered. Joe, we don't know what we don't know until we know it.
That's exactly right. And guys, we are doing each month now, we are doing a learning lesson. And on the 16th, the episode 2 weeks ago, we talked about, we showed the difference, right? We did a case study for you guys. Go back and check that out if you really want to see how being the bank versus being the landlord is, 2 times or more as good, right?
That's it.
That's it. All right. So the housing market, Eddie, this has a lot of words on it, and I know it would drive you crazy, but I wanted to get this out there. Housing inventory in southern states has reached multi-year highs in previously hot markets. Look at this. Nashville listings have jumped here, and they're 30% higher than the previous year. Look at Atlanta. Up 53% year over year. Look at Florida. Well, here's our listings here, and 200% above the pandemic lows. And then the pattern's not limited to the South, right? States like Arizona, California, Washington have seen inventory growth 40% year over year.
Joe, let me summarize what I think the smartest people in the market are saying.
Mm-hmm.
Okay. And that is home buyers are waiting for a big drop in rates before they decide to buy, but the market is not giving them that. And the truth of the matter is it may not give them that.
That's right.
Right. Rate trends are not exactly going as people anticipated.
That's right. That's right. And yeah, we'll talk about that as we move forward here. So inventory listings, you can see this line basically is up. Yep. Again, it had dropped here in the lowest levels in 2022, but since then, you had a couple of little bumps here, but right now, here we are. So housing inventory is definitely on the way up. And that's from Fred. This isn't some website. This is our guy.
It's not some promoter saying it.
No, it's not a promoter, Eddie.
Okay.
We're focusing on non-promoter stuff this week.
That might be highly advisable.
Just the facts, right? As the guy used to say on Dragnet. So yeah, a lot of people won't know who that is. Eddie, I found this interesting. And this was from Realtor.com, Lending Tree, and so on. So despite housing shortage, America has 5.6 million vacant homes. This goes back to something else. So it says just because there are millions of homes sitting vacant across the largest 50 metros doesn't mean there's an overabundance of housing. Rental vacancy has climbed in recent years as rental inventory has increased in many markets. That means that more rentals sit empty, waiting to be rented. As a matter of fact, homeowner vacancy rates right now for homes you're buying are 0.09, less than 1%, and rent. Interesting stack, right?
I'm going to say that is the amateur landlord.
Yep.
I'm going to say that the amateur landlord, which is pretty dominant in the market, they dominate professional landlords, 10 to 1.
We know that, right?
And this is the thing, and they sort of given up. And a lot of times 60% of those houses were probably paid cash for them. Yeah. And they don't know what to do. They've been kind of exhausted by the fact that every time they fix up a house, they rent it. And to get it fixed up again after that tenant trashes it, cost them more than they ever collected in the rents. And it's a vicious cycle. And it's very interesting because I'm very involved with the top real estate investors in the country, house buyer types.
Right.
And they're struggling with getting the conversion rates. They're making far more offers with far less yeses. And we talk about what about these? And so it's kind of interesting. Sometimes, Joe, human behavior doesn't exactly act like the stats tell us.
There you go. And we know this is the average burnout landlord. We have the stats, right? There's nearly 17 million homes owned by amateur landlords. 60% of those, as you said, almost 11 million are owned free and clear. And they're just letting them sit.
Great dimension, Joe.
For sure.
Big opportunity there to go seller finance those houses.
That's exactly right. Give them what they wanted in the beginning, which was real passive income. This is about the same from August. We've been showing this every month from Resi Club, and it's about the same inventory. Other than what is that?
This is September of 23. Oh, and the change now to September of 24. So it's the increase in listings year over year, or month. That month last year versus this month this year, and basically there's not any less. Well, there's, what is that? North Dakota, South Dakota?
Yeah, North and South Dakota.
There's 700 houses in North and South Dakota anyway. So, I mean, that's a big number.
Yeah. That's right.
Did I say
All
that?
right. Let's talk about the banks and the Fed, guys. So, yeah, rates have come down a little bit, Eddie, for sure. I think the biggest challenge was that the market had already priced in that rate cut that was done in September.
That's exactly what people saw. People thought the Fed rates, and then all of a sudden rates actually went up a little bit.
Yep.
Because mortgage rates are based on 10-year T-bill rates, not Fed rates. So anyway, watching that closely, and I'm the experts are kind of saying out there, be careful of anticipating some big giant sliding rates.
Yeah. And well, the Fed had October off, so they'll do a November and December, but there is no indication that there may be a 25 basis point cut, but who knows? But that's not going to affect this for any reason, right?
Yep.
And here's another from Market Watch. Eddie, these are the experts. 11% say the rates are going to go up, right? 56% said they're going to stay the same. So only 1/3 of those feel like that rates are going to go down.
Joe, do you know that not everybody's going to vote for the same presidential candidate?
Yes, sir.
You know that?
Yeah.
Okay. Well, they're not all going to vote the same on this. I think that stay the same is where I see most of the smart money betting. And look, my crystal ball broke, so I don't. Who knows? Right. I could be wrong.
Yeah, for sure. All right. So this was one that you had sent me, and Fed Governor Waller says need for caution ahead when lowering rates. Signal future interest rates will be less aggressive than the big move back in September.
Listen, this inflation thing is still not where it needs to be.
Creeped up way over 3 again. Yep.
And, Joe, it's going to stop a lot of Facebook posts, because when rates dropped in September, I think there were 7 million Facebook posts that rates were going to go back down to 2 again, so to speak. I'm kind of being a little facetious with you, but you get my point, right? So, yeah, I think let's just use the word cautiously optimistic.
Yeah, cautiously optimistic. I think, anyway, we'll see. I'm going to save judgment, but I think it's going to end up in the mid-6s through the rest of this year. Maybe, yeah. Anyway, okay. Weekly mortgage demand tanks 17% after interest rate hits the highest level since August. And this is the rates we were just looking at. 6.5.
That's exactly what we just talked about.
That's exactly what we just talked
about. The bond market and the mortgage industry anticipated the rate cut before it actually happened.
That's it.
And so then all of a sudden, everybody thought mortgage rates were going to continue to go down. And the answer is they actually flipped and they actually went up a little bit.
That's it.
And people freaked out.
That's it.
And the answer is it's because I think it's social media, Joe.
I do too. Well, anyway, when you have a
sports opinion on social media, you always know what you're talking about.
That's it.
Nobody on social media that gets on there and makes some big post, none of them are like uninformed. They all know the business.
That's it. They know it intimately.
You get what I'm saying?
Yeah. So, U.S. banks are under pressure. They're getting ready to report, or ready to report their earnings for the third quarter. And J.P. Morgan, 8% drop, Wells Fargo, 14% drop, and they got out of the mortgage business, right?
Mm-hmm.
Bank of America, 14%, Citigroup, 20%. None of those are going the other way, and Goldman, 35%.
You can mark this one on the wall. Yeah. The top 25 banks are not subject to be under watch.
That's it.
But the other banks, and there's 4,800 FDI insured banks in the United States. The other banks, I'm not cautiously optimistic, Joe, in that one.
Yeah.
It is if the big boys are having trouble, the little guys are swimming, and we are telling you they're swimming. And don't believe us. Just go do your research.
Yeah.
Right. Your research will lead you to the fact that, oh my God, the banks who are deeply, deeply committed to commercial lending, which commercial real estate is continuing to drop, and we'll talk about that.
Yeah.
This is their Achilles heel, along with consumer loans that are continuing to get more and more delinquent.
Oh yeah. We could do a whole show on consumer loans, auto, credit cards. Yeah. Yep.
All this leads to good stuff for notes.
That does. And this does too, right? So $197 billion has kind of decreased in the regular banking system, and the deposit flight comes historic piles of money into money market accounts.
Yeah, people can't find anywhere to put their money.
6.54 trillion in October of this year, this month, right?
We're sitting in more cash in this country than we've ever had in the history of America, and it is because that's what people say when they show up at Note School. They say, I wanted to invest in these other things, and I don't have confidence in it. And people are moving out of rent houses. People are moving out of particularly syndications, but specifically multifamily. And they're taking their money and they're doing something else with it. And this is a reflection of this is the evidence showing you that people don't have confidence in those types of investments.
That's right.
And I don't believe that people are walking around there walking on clouds right now, thinking the stock market is going to keep the air in it. So Joe, this is why you have to know the market conditions, the weather report, because otherwise you aren't prepared for the storm. If you prepare for the storm, you can always make money and opportunity out of markets where other people aren't making money.
That's it.
The deal is you got to pick the right thing.
Well, it's like our old friend Buffett, not Jimmy, but Warren says, when everybody else is running to it, run away. When everybody else is running away.
I used to take a lot of my financial advice from Jimmy Buffett, but
he did pretty well.
Well, he did well at singing songs, not so much at financial advising. Right?
No, that's for sure.
All right, let's roll it.
All right. So, Eddie, why does all this matter? Look,
it matters because you got to understand the void. The void is when people like us do well.
That's it.
The mortgage production is down. Half the people that can qualify for mortgage can't qualify anymore. And this is what we're saying. We've entered a note cycle, and we're looking at other market conditions driving it back to, okay, well, last year we experienced a 25% increase in notes.
Yeah. Why?
Because notes are filling a gap. They're filling the void.
Yeah.
All right.
So let's talk about multifamily.
That's going good, Joe. I'm going to tell you right now, I heard a promoter yesterday saying how good it was. The trees were going to grow to the sky in multifamily.
Yeah. Well, and this, again, is just the facts. No headlines, just the facts, guys, from the Federal Reserve. And this is just, you see this line, it's blipped just a couple of little times here, but, there's still $600 billion. And this is in multifamily. This doesn't include the other, $2 trillion or $3 trillion in office and all of that. There's a lot of those loans out there, and we know. Well, we'll show you here in just a second. But that line is right where we think it's where it's supposed to be at this point.
And these are the banks that we're talking about that have basically 45% of all of their loans on the books or commercial loans in an asset class that continues to decline in value.
That's it. And these are
people say, why are you guys it's just data, we've analyzed the data. We didn't invent any of it. We're not doing much more than kind of copying what what we think are the real experts are saying. We're just giving to you guys in a summary form that you can kind of see it and how it relates to notes.
Eddie, I'm going to say it this way. This isn't Eddie and Joey Downer. This is just what it is.
Yeah. If the market's kicking butt and calling it good, we're going to call it good.
We're going to call the ball. All right. So interest rates and price indexes, multifamily real estate apartment price index. And you can see right here, this was about 2022. If we kind of slid right down here, Eddie,
Yeah.
So, it's a continued fall as far as the interest rates and price and indexes for multifamily.
Okay. Send that slide to me. I have a mutual friend that needs to see that this morning.
You got it.
No, no kidding. No kidding, right?
Yeah. Yeah. This is completions, right? As far as completed and underway. And, that is going to level off, Eddie. I mean, it was here. And, that's what another almost 250, 275 or so.
Yeah.
Units completed. And these are big projects. These aren't, duplexes, right? These are apartment complexes. And it's going to level off eventually.
Yeah, they're to get a new loan right now, to take a project out of the ground right now, the cash that you would have to come with to get a lender to loan you the money would be horrendous. The financial modeling that you would have to run your numbers on today would be horrendous. The problem is these projects were started 2 and 3 years ago, and the financial modeling doesn't fit what the market has given them. That's the problem.
Eddie, we used to say this a lot: the juice ain't worth the squeeze.
Yeah, no kidding.
Yeah.
All right.
So from our friends at TREP, these are the gold standard in research here. And this is the one we're looking at, right? Multifamily.
Yeah, so it says special servicing, guys. That means a loan has fallen out of the good status.
Yep.
Right. And now it's gone into the hospital, so to speak. And that means that when you start looking at the trend, 1 year ago, we were at 3.15 and now we're at 6. And Joe, that'd be another one of them slides that you send me, because people are asking these questions because they're like, no, I've been around multifamily, and those guys, those operators are not saying this. They're not saying, of course they're not saying it. But the truth of the matter, it is what it is. And yes, I don't think any of them have amped up as strong as, multifamily is essentially doubled.
That's it. It has. Right. Yep. So we first picked this up last month from RealPage, who does a lot of the analytics in this space in multifamily. And so what we saw was, and this is just kind of a continuation from last month, but we see that the renewals are continually, they're going down a bit, but this just kind of makes sense, right? We did talk about this last month. So Eddie, and the new leases are going up. I wonder why.
Because the people that are renewing are not giving spiffs, and the people that are offering a new lease to a new tenant they haven't met before are giving spiffs. They're giving bonus money and free rent and free cable and so that they can entice them in. So your tenants are doing a flip over.
There you go. Yep.
And when you look at it, the A units are going to get leased up.
Yeah.
The B and C they're going to vacuum people out of there and they're going to send them up. And you're saying, yeah, but people have less expendable capital, and they've got to go to the lower price units because they can't afford the higher rent. Well, what if they're not paying the higher rent effectively, Joe?
Yeah.
What if they're getting little things to do it? But the B and C tenants are doing anything, apartments right now are doing anything they can to get people in there, right? Including what percentage of them, Joe, are giving offering special deals to get people in?
Oh, yeah. Well, we're looking at it's continually going up right now. It's over 20. It's 20, almost 22.5% for the C properties, and the Bs aren't far behind.
Yeah. So call it about half, slightly less than half. They're doing stuff, giving free rent and free cable and doing this stuff. They're effectively lowering the rent. They are lowering the rent without lowering the rent.
There you go.
Yep.
That's it. All right. Well, let's move into non-performing. And again, this is kind of the first look. And we didn't do a whole lot of slides on this because these two that I did for this, it's just what it is. So, so the national delinquency rate, Eddie, has fell back 3 bits, right? 3 basis points to 3.34 in September. And that's dropping another almost 1% from the month before. But there's always a but, right? up 5.1% from last year. Serious delinquencies, right? Loans 90 days plus rose 14,000 units to 3.3% in the last, to a 6-month high.
Uh-huh.
And nearly 70% of serious delinquent mortgages are protected from foreclosure via forbearance, loss mitigation, or bankruptcy.
You don't think that would have been politically positioned?
Motivated?
They held off letting mortgage companies continue with foreclosure until the elections are over. I'm just saying, I'm just curious if anybody's ever thought about that possibility.
Yeah. And look at that. Early stages fell marginally, while cures from 30 to 60 days late to current worsened by almost 12%. So, yeah. And Eddie, this next one, the numbers have been trending down. These are the latest numbers I plugged in here. So we're at 1.988, and that's up from 1.873. That's, what is that? 110,000 more in September than August. And look at the days.
Look, guys, look at the far right, top far right. Circle that, Joe, with a red pencil.
Okay. I'm going to change my ink here. You go ahead and talk while I do that.
So here's the bottom line. The bottom line is average days delinquent of loans in foreclosure. Average days delinquent of loans in foreclosure is 1,231 days. That's why these people are not going to go in there and modify, and that loan is headed, the destiny is foreclosure, or either sell the property and pay off your mortgage and go end up with a little equity out of it.
Yeah.
And that's why we're saying that number has been trending from 1,000 days to 1,100 days to now it's more than 1,200 days. It's been trending worse and worse and worse, which tells us that our sludge in the mortgage barrel is going up. Good loans versus bad loans. The sludge, the bad loans that are the sludge at the bottom of the industry is going up.
Eddie, and look at it. There was 27,400 starts in September. This is the latest numbers, and 5,700 completed. Well, divide.
It's sludge, and the sludge is getting more because they pushed 5,700 out, and they finished foreclosure, and they put 27,500 back in.
Yeah,
and this is what we're saying. So this is an opportunity for us, and people say, "Well, when is it going to break?" And there's going to be this giant, like the word on the street is, Joe, that it'll be fairly different after the elections.
Yeah, yep. So, Eddie, that is it for this week. And it's that's just the facts, no fluff, just facts.
All right. Joe, that was excellent. A lot of information. So the trajectory that we see our industry in is continuing to be, the note industry has a good runway in front of it. We are filling a gap conventional lending isn't filling. We're seeing people come into our market with capital because they're exiting away from rent houses and exiting away from multifamily. And they're saying, what's the next opportunity I could invest in? Oh, notes. It takes less aggravation. I get way more cash flow, and I control the asset. I'm not in a syndication. I control the asset. And for those reasons, that is exactly where we see the market going. And Joe, we're going to monitor it. We're going to anything that turns good or bad, we're going to call it as we see it, but we're going to continue to try to do that. So with that,
let's say one more thing before we go.
Oh, Note Expo.
In 1 week, right? In 1 week from today being the 30th, we'll be, rolling into Dallas for Note Expo.
Yeah, guys, listen. Note Expo is going to be where we're going to put the experts on stage that talk about doing the business the best,
Mm-hmm.
not doing it average, but doing it to excel, doing it in a way that makes the most sense. And we're going to have the experts on stage that's going to give us the vision to do that. If you are interested in this business and you are missing Note Expo, I'm telling you, you are missing community clarity and market vision.
And getting your plan together for 2025.
So please, if you haven't gotten your ticket, come on. We're gonna help you out with. We've decided that because of the market and so many people shifting gears, we're not going to go raise the price. We could, and we're not going to run out and go raise the price. We're going to leave it as it is, and we're going to keep the door kicked open and say, you guys come do this. But I will assure you, if you will come to Note Expo, you're not going to leave there disappointed. That is a promise. That's a promise. All right.
All right. Well, listen, you guys have a good week and rest of your week, and we'll see you next time.
Adios. Bye-bye.